Welcome to the latest trade floor update. Rob, a narrative that we've been talking a lot about over the past few months has been this shift from policy-supported growth to an environment of more organic-led growth. It feels like we're either at that junction or very near to that juncture. So with that in mind, what does it actually mean for markets?
You're right, we have been talking about it for a while, and I think it's sort of playing out in real life. So if you think about some of the changes in the settings around central bank policy, so even in Australia we've had the TFF, all this jargon, YCC, all these things being removed. And I think we'll expect something similar early next year when there has to be discussion around QE or quantitative easing. So essentially it means all these various tools that central banks, especially the RBA, have been using are slowly being unwound and will slowly move into a phase of more policy normalisation, which means interest rates going up, markets already pricing first hike middle of next year, middle of 22, with another 3 or 4 hikes to happen reasonably soon thereafter. And final thing is that RBA just in their most recent meeting took out that reference to 2024 as the first rate hike. So the market's really getting prepared for that in advance.
So with that backdrop and the bond market repricing and already beginning to price in these potential interest rate moves, what does it mean for portfolios? What does it mean for your portfolio, and how should investors think about their own portfolios?
Yeah, sure. It means a few different things. So any asset that's been benefiting from policy support directly, like things like credit assets, you need to be much more bottom up. You need to really think about the fundamentals of the individual assets you're investing in. It's no longer this tailwind of policy. You need to really understand the cash flows. It means that things like illiquidity premiums, complexity premiums will become much more important in investors' portfolios. And then really understanding that stress test, making sure that, the assets that you're investing in not only provide the income you expect, but also have some underlying fundamental strength in terms of capital preservation. So things like structured credit, RMBS, some of the other exposures, even in commercial real estate, anything that's got some very sort of natural protection and performs in stressed environments as we move away from this sort of policy backdrop, those are the assets to focus on in 22.
Well, thanks, Rob, and thank you for joining us. To learn more about our credit views, to understand how to access illiquidity and complexity premia, please visit pimco.com.au.